Hello everyone, this is Dhanesh Fulfagar, and today my colleagues and I are here to talk to you about this book called You Can Be a Stock Market Genius by Joel Greenblatt. Now, Joel Greenblatt is a huge proponent of looking for returns off the beaten path or in special situations specifically. Now, why special situations? Because he says that the opportunity relative to the capital over here is too small for institutional investors who are managing billions of dollars or rupees in the Indian context. And because of that, there is not a lot of research that is done on special situations. Now, while large players are not looking and a lot of research is not being done in special situations, that means that it gives you an edge against most of the people competing for returns in the stock market. Special situations like spin offs, mergers, merger securities, bankruptcies, restructurings, rights offerings, recapitalizations, all of these are places where hidden treasure, according to Joel Greenblatt, can be found. And so now what we are going to do is discuss each of these special situations for you so that you can understand how to play them and how to analyze them and how to understand them and use them in your strategies. So let's go. Now, one of the special situations that Joel Greenblatt talks extensively about are spin-offs or demergers. Now, what is a spin-off? Let's say, for example, a conglomerate holds five businesses under one listed entity. What it wants is for these businesses to perform independently under their own respective managements. In such a situation, this business must go through spin-offs or demergers. Think of Adani Enterprises Limited, who spun off Adani Green, Adani Gas, etc. Now, why do businesses go for spin-offs? Usually it is to unlock more value. One of the reasons, or rather say, unlock pure play value, which is basically if you separate unrelated businesses, each business can be valued independently without a conglomeration discount because maybe markets don't really know how to value so many businesses all strapped into one, right? It could also be to actually separate a bad business from a good business, which is basically, let's say a conglomerate has two well performing businesses and one bad performing business. Due to the bad performing business, the conglomerate actually gets a lower valuation. So demerging that or spinning that off would actually bring more valuations. Or let's say that there is another company that wants to acquire one company from a conglomerate. Now, this will cause a lot of regulatory hurdles, and because that other company does not want to acquire the conglomerate as a whole, a demerger would actually solve a lot of strategic and regulatory issues. Now, how is it that actually we can profit from these spin offs? Well, basically, what happens, let's take for the example that there is a business which has two businesses, basically, one entity which has two business, one well performing, one badly performing. Now, once the demerger happens, according to the ratios, the shareholders would get shares of both the businesses post the demerger, right? But who wants to hold this bad business? Now, because of that, there will be a lot of institutional selling and a lot of shareholders basically selling their stake in this bad performing business. That would actually cause this bad performing business to probably be bought down to such a valuation which is actually much lesser than its actual valuation. That might provide you an opportunity because eventually, under a new management, there might be new entrepreneurial forces which would be unleashed, and maybe they could turn this business around. And while you get it at a steep discount from its actual value, there is a margin of safety that it offers you as well. Now, this institution selling can take a long time, maybe sometimes 6 months or a year, and that can keep the valuations low for a long time. So it also provides you an opportunity to actually do a lot of your analysis about these demerged entities and then invest in them. Now, history has proven that playing demergers or spin offs as an investment strategy has been very return generating for the investors, and probably a lot of the times it has also helped them beat the market. To understand actually how a demerger makes money, let's take a rough example, taking a dummy company who's going through a demerger or who's announced a demerger, and let's see what that demerger can do. So, while beginning to look at companies after the demerger has happened can also help you make money, let me explain to you how you can make money right after a demerger is even announced. So, first, we need to understand how the demerger process works, right? So, first, the company will internally decide that it wants to do a demerger or a spin off. After that, it will go for shareholder approvals, and then it will go for regulatory approvals like approvals from the NCLT or SEBI. This process usually takes around a year and a year and a half, or a year and a half. Now, let's take the example of this company. Now, say they have just announced a demerger, and you go and look at the financials of the combined entity first. You see that it earns 1,000 crore revenue, out of which it makes a 60 crore PAT, which is a 6% margin. It has gross margins of 70% and EBITDA margins of 25%. Now, you basically look at the two companies inside this one company, one of which is a bad one, and one, or rather, has bad fundamentals or worse off, and one has good fundamentals. And you separate these two. You see that both of them have an equal revenue, but the gross margins and the EBITDA margins differ. For company A, the gross and the EBITDA margins are lower, while for company B, they are higher. The company A makes a loss because of its depreciation and the interest payments that it makes, while company B maintains a very healthy profit margin of around 18%. Now, you think that now, if today, let's say the combined entity is valued at a PE of 20, and you see that both these businesses are different, which like for company A and company B. Now you look at peers of company B and you realize that these peers as well have a PE of 20, while for company A, the PE might be that the peers might have a PE of around 10, but because company A is making losses, let's take the valuation of price to sales. Let's say that the price to sales for the peers of company A is actually 1, but because company A is in a loss, we assume and give it a price to sales of 0.5. Now, if we begin to give company B a price to PE of around 20, 20 multiplied by 9 implies a market cap of around 1800, while a price to sales for company A, a zero point 0.5 price to sales, would imply a market cap of around 250, which is basically 500 multiplied by zero point 0.5, correct? Now, if you add this up, the total comes up to around 2050 crores, which is actually 71% higher than what the combined entity today is getting, because it includes both the bad and the good business. Now, this means that over a period of 1.5 to 2 years, you can actually make a return of around 71% if you play this demerger.
So now that we have understood what demergers are, let us try to deep dive into a very specific kind of a demerger, right? Where there is a larger entity, which is a capital guzzler, has lower intrinsic ROIC, maybe cyclical, maybe prone to regulatory changes, and then there is a smaller crown jewel in that business, right? Which carries the actual value. It has very high ROIC, very high cash generation, and also requires lower invested capital. Now, why do these? So even if there is such a crown jewel in the businesses, why is there is such a depressed valuation, right? First of all, the investors are worried that the incremental capital generated by this crown jewel is going into a lower ROIC business, right? Second, some investors may be interested in the cyclical business or the larger business, right? They're cyclical investors, but some investors are interested in the crown jewel, right? The higher ROIC business. We'll discuss a lot of examples in Indian context as well, but this is the reason why the valuation is depressed low. We'll also see the mathematical calculations behind it, right? So in the book, there has been one of the case studies that has been mentioned, the case study of home shop 18 network. Now we'll not go very deep into the case study, but there was, like I said in the previous slide, there were some very important things that you have to see, right? So there used to be a broadcast business which was depreciation heavy, right? And then there used to be a retail entity, right? Now the problem was that when the overall P&L was being made, the depreciation of the Silver King business reduced the overall profitability of the business. And when you give a multiple on top of it, the valuation always remained depressed due to this. Now, in this case, an SOTP approach is much more valid. We'll discuss about all this with a very good example. But all you have to understand is for now that the depreciation of a much larger entity, the broadcasting business, was depressing the valuations of the retail business as well, right? Which should be valued on, say, the earnings multiple. And where a depreciation business heavy should be valued on basis of a cash flow multiple or an EBITDA multiple, right? So let us get to the case study now. So we there are some assumptions that I have made. Now there are two entities. Like I said, I have taken the same example. There is a all you have to understand is that there is a larger entity with a very high depreciation. For example, the broadcasting business. So for example, I'll discuss an example where there is a steel company mingled with a wire and ropes company, right? So the steel division is usually depreciation heavy, carries higher interest cost, but all you have to understand for now is that there are two entities and the overall debt of the conglomerate was 1600 crores, right? Now what has happened is that this is the pre-demerger. Now there has been a Notice for a demerger for this business, so the overall entity demerger debt on the balance sheet was 16, let us assume it was 1668 crores, right? Post demerger, most of the debt goes to the broadcasting company. Now you might ask, if the PNL is already depressed for the broadcasting company, why is most of the debt being transferred there? You have to remember that PNL doesn't work on, it only works on accrual basis, right? So the broadcasting business, we are here, it is a cash flow generating business, right? And how do you pay interest cost? By using your cash flows, right? Next, let us look at the pre-entity, so before they were demerged, right? Now as you can see, I just want you to notice these two things. One is the depreciation number and one is the EBT number, right? So as a percentage of EBT, depreciation was almost 70%, right? Due to which the overall net income was getting depressed. Now if you give a multiple on top of it, now say you give a 10 times multiple on top of it, now we'll go to the valuation part of as well. But you can see that most of the profitability was getting eaten up by the depreciation. But where did it belong to? It belonged to the broadcasting company. Now post demerger, most of the debt gets most of the depreciation gets transferred to the broadcasting company, right? And most of the interest expense, now like I said, right, we are transferred. So in the assumptions sheet, I showed you how most of the debt was transferred to the broadcasting company because it was a cash generating business. The depreciation that came up was in the form of amortization of goodwill, right? Or just simple depreciation, right? But yeah, so because of this, now as you can see, the retail company, look at the depreciation, right, as a percentage of EBT, right? It has gone down barely to almost 8%, or even low 8 to 9%, right? Now here's the interesting part. When we go to the valuations table, let us look at the SOTP. Now this is the best way to value any company, right? So when the businesses were combined, they were getting, say, a valuation of 10 times earnings multiple, right? So on a net income of 411 crores, a 10 times multiple meant 4,117 crores of total market capitalization, right? So if you are assuming that there are 100 crore shares outstanding, the total share value comes out to be 41 rupees, right? But now after demerger, what happens is that, now how have we come with the multiple of 14 times? Let us discuss the rationale behind that also. For retail businesses, the lower end of the business, where these businesses which hit the maturity curve, they are typically valued at somewhere around 10 to 30 times multiple, 30 times being in the higher, the retail businesses being in the higher growth phase. So we have taken it on the lower band, we have taken the 14 times multiple. And for the broadcasting businesses, we have valued it based on the EBITDA multiple and not the earnings multiple, right? Because the depreciation eats away the earnings, right? It artificially depresses the earnings. So either we should look at the EBITDA multiple or the cash flow multiple. So based on that, if we go to the same mechanism, if we take the net income of the business of retail business, and if we take the EBITDA of the broadcasting business, or the EBITDA of the broadcasting business, the overall value, now if we combine the overall share value of this and this, right, post demerger, so we have used an SOTP valuation basically, you can see that the per share value comes out to be 77 rupees. Now before demerger, you can see that the overall value was 41 rupees. Now what is happening exactly? What is the mechanism? Like I said, it's the depreciation. If you are valuing it on the basis of an earnings multiple, right, the overall PAT multiple, the problem is that the depreciation is eating away most of the uh, profitability, right? But these should be valued differently, right? The broadcasting business should be valued in terms of cash flow multiple or EBITDA multiple, and the retail business on the other hand should be valued on the earnings multiple. So like I said, in the broadcasting business, most of the so I have used EBITDA as a proxy for cash flow. Now I know it's a shortcut way of considering it, but if you see the broadcasting business generated about 206 crores worth of cash flows, right? Even if you look at the profitability is a negative, right? Because mostly because of the depreciation, which is mostly in terms of goodwill, right? But what matters to us is the cash flow that the business generates. So that is one of the reasons, as you can see, when they are valued differently, when they are valued separately, the valuation is much higher, and that is why demerger is a great way to unlock value. Now let us understand some Indian examples as well. Now in terms of Indian examples, there was a company called Usha Mate, which had two divisions, right? There was a crown jewel, the wire and ropes division, and the steel division, right? Now the wire and ropes division, as you can see, the sales split was almost 50-50, right? And let us look at the capital employed, for example. The first of all, let us look at the amount of capital employed. Most of the capital employed for this business was in the steel division. But here is the interesting thing. What was the crown jewel in this business? The wire and ropes division. Now, don't just go for the capital employed directly. We have to look at the EBITDA per ton. There are various other metrics. We'll get to that as well. But all you have to understand is that the crown jewel of this business was the wire and ropes division, right? And then there was a cyclical division, which was the steel business, right? As you can see in the margins as well, that the steel division had a very violent up move in margin, down move in margins, right? Whereas the wire and ropes division was a much more a better business, right? So, for example, let us say that the wire and ropes division has EBITDA per ton of almost 10 to 15,000, right, which is way higher than comparables like APL Apollo, or I know there are not direct comparables, but if we are assuming them as converters, they have very high profitability metrics, right? And now with the addition of VAP and the construction activity picking up, look at how profitable this wire and rope division is. Now, what happened is that this business was proposed for a demerger where they sold off the steel division to Tata Steel, right? And whatever the cash they got, that was used to clear off debt. So you can see a large, sharp drop in debt as well, right? Now, if we go to the P&L, you can see that most of the interest cost, just a minute, yeah. So let us close the segments, yeah. So most of the interest cost and the depreciation cost was because of the steel division. But post the demerger, look at how the changes in the interest cost and the depreciation cost, right? Now, once the wire and ropes division was valued separately, and people noticed that this was a higher cash flow generating business, a very high superior EBITDA per ton business, not as cyclical as the steel business, this business got re-rated, right? So this business became almost a 20 to 30 bagger in the past 3 to 4 years, right? The next is the tips music business, right? Now, Tips Music had basically two entities, right? One was the music licensing business. Now, music licensing business was a very high ROIC business, right? So, as you can see, the return on capital employed now, this is obnoxiously high, right? Why? Because this is a catalog driven business. So, once you build a music catalog, you can simply recycle those songs, so they can even if it gets played on say Spotify or something. So basically what Tips Music, or there is another company called Saregama, they collect royalties on this. So every time that music is played on YouTube or on say Reels, the Saregama and Tips Music, they collect a royalty on it. So can you imagine that once you've built a very healthy catalog of businesses, this the older musics also keep getting reused, right? The royalty business is very high ROIC business, right? It's a very high operating leverage business as well. So, but it was clumped up with the film distribution business, which you can see had a very again the numbers look odd because mainly because this is a business where you do not know whether the film will be successful or hit or not. It requires a lot of capital for that business as well. So once this business was demerged, so you can look at the how the margins shot up, right? So just a minute, let us go to the yeah. So as we can see, the margins used to be, the overall entity used to be extremely volatile, right? Why? Because the film distribution business. So if let us go back to the product segments again, and let us go to the capital employed in the business. So most of the capital that was employed was into the film distribution business, right? So film distribution business is a very high, very low return on capital employed business, right? So that the overall valuations of the business used to remain depressed. But once it was hived off and it was listed as a separate entity, so there is a Tips Music and there's a Tips Films, we could observe that there was a massive re-rating in the stock of Tips Music as well, right? So these are some of the ways we can see how demergers unlock value, help in unlocking value, and specifically when there is a larger entity and there is a smaller crown jewel in which has a very high ROIC, and when it is demerged, how it unlocks value for that crown jewel specifically, right? Thank you.
Let me start by explaining what a right spin-off actually is. In a normal spin-off, shareholders don't really have to do anything. The company just gives them the shares of the new business. Whether they like it or not, they become the owners. A right spin-off works differently. Instead of giving shares for free, the companies give shareholder a right, basically an option to buy shares of the spin-off at a fixed price, but it does not force you to buy. So now as a shareholder, you have a choice. You can use the right and buy the shares, you can sell the right itself, or you can just ignore it. The one difference is very important here. Because the ownership now becomes optional, only the people who actively choose to participate will end up owning the spin-off company. Let's suppose 10 lakh right shares were issued and only 4 lakh people participate. So for that remaining 6 lakh, there's an option of oversubscription privilege which gives participating shareholder a right to buy the additional share if they wish to on a pro rata basis. Now let's see how a right spin-off plays out. So in our example, parent company has 1 crore shares trading at 100 rupees. So the market cap becomes 1000 crores. Now inside this parent company is a business that is going to be spun off, and that business has an estimated value of about, let's say, 300 crores. This 300 crores is not the market price of the spin-off stock, it's the estimated value of the business based on the assets and the earning potential. So that value already exists before the right offering happens. So the right spin-off is not about creating this value, it's just deciding how the value will be owned among the shareholders. Now the company announces the right terms. So for every 10 shares of the parent company, you get one right. Now since the parent has 1 crore shares, that means 10 lakh rights are issued. Now this each right allows you to buy 1 shares of the spin-off by paying either 500 rupees or 5 shares of the parent company. So on paper, the maximum numbers of spin-off shares that could exist is only 10 lakh. This 10 lakh shares issued for spin-off companies happens only when we assume that everyone participates. But in reality, that's not what happens. So now this is where the idea of illiquidity comes in. Parent company could have easily issued 1 crore shares worth 50 rupees each, but it intentionally issued 10 lakh shares worth 500 rupees each to reduce the numbers of participants by making the stock illiquid. Now with more shares at a lower price, lot of people can buy and sell easily, but with fewer shares, every trade matters and the stock becomes harder to trade. Now, so this is why the institution is usually avoided, because the stocks will be illiquid to trade. Now coming to the retail investors, they often ignore it because they need to put extra cash, and because the structure isn't very exciting or heavily marketed, it feels very complicated to them. So they don't tend to participate. So now instead of 10 lakh rights being exercised, only 4 lakh rights are actually used. That means only 4 lakh spin-off shares are created. Now, regardless of whether 4 lakh shares are issued or 10 lakh shares are issued, the same spin-off business worth 300 crores is transferred. That business does not change. Only the numbers of shares in the denominators changes. So let's do a simple math. If 10 lakh shares existed, 300 crores in the numerator divided by 10 lakh shares gives you about 3000 per share. But because only 4 lakh shares exist, the numerator of the business 300 crores remains the same, but the denominator is only 4 lakh shares. So the value per share becomes 7500. That's a 2.5x different upside created purely because fewer shares are dividing among the same business value. So there is no growth assumption here. There is no improvement in performance or speculation, just simple division. So the core idea of a right spin-off is actually very straightforward. The company already owns a business with value. So instead of giving that business to everyone equally, it asks shareholder to actively participate in. Because many people don't participate, fewer shares are created, and when fewer shares are created among the same business value, the value per share goes up. Now that's the whole mechanism of how a right spin-off actually plays out and how people make money out of it.
Hello everyone, I'm Ayush and let's discuss partial spin-off. In partial spin-off, management decides to sell or distribute some of its shares of any particular division to its shareholders or public. In 100% spin-off, management sell its entire stake holding, but in partial spin-off, management continues to retain the majority shareholding. Now, why would a company go for a partial spin-off? There could be many reasons. For example, first can be to raise additional fund. If a company needs a fund, they can sell 10-20% of stake of a particular division and raise a fund. This can be a very good option if that company can't afford to take more debt. Second could be to unlock a hidden value of any particular division. Inside a large conglomerate, it's possible that any particular division might be undervalued. It could be possible because our other divisions are not performing well. So by listing that particular divisions, the division can get a true market value what it actually deserves, and investors will be able to price that business independently. Third can be to incentivize the management. The standalone listed shares of a division will enable the share-based compensation. It will align management incentives with that division's performance as well as that share's performance which was not available earlier. Now let's take a small example. Suppose XYZ has a division called Widgets, and Widgets has 10 million shares. XYZ decides to list that business and offload 20% in that Widgets. It means it sells 2 million shares to the public. Now suppose after listing that share price is now around $20. So the widgets which still holds 80%, that is 8 million shares and worth $2 per share. So now the total value is $160 million. And suppose the market value of XYZ Limited is 500 crore. Now, if we deduct the market value of widgets from the market value of XYZ, we get $340 million. That is nothing else but the market value of XYZ excluding the widgets. It means it's the market value for rest of the businesses that XYZ does. Author further shares a wonderful case study of Sears. Let us try to understand that case study with dummy numbers. Suppose A Limited has two divisions, B Limited and C Limited. Both of them are listed. Let me share with you the objective of this case study. So what we are basically trying to do is we will try to find out the value of B Limited and C Limited, and we will deduct its value from the total group level to find out the standalone A Limited's value, and we will decide that if that value of standalone A Limited is justified or not. Let's suppose that A Limited has 1 crore shares outstanding of 50 rupees each, and A Limited holds 50 lakh shares of B Limited of 15 rupees each, and also holds 1 crore shares of C Limited at 30 rupees each. Now, if company decides to distribute its shares of B and C to its shareholders, so 50 lakh shares of B Limited will be divided equally among the 1 crore shares of A Limited. It means that a shareholder of A Limited will get 0.5 shares of B Limited for each shares he have. 0.5 shares, it means 7.5 rupees. 1 share of B Limited is of 15 rupees. He will get half shares, that is of worth around 7.5 rupees. So for 1 share of A Limited, the shareholder will get 7.5 rupees of shares from B Limited. And similarly, 1 crore shares of C Limited will be divided among 1 crore shares of A Limited. So the ratio is 1:1. It means entire 30 rupees, because 1 share of C Limited is worth 30 rupees. So now in A Limited, for 1 share, the shareholder is getting 7.5 rupees value from B Limited and 30 rupees value from C Limited. Combine it's 37.5 rupees. And the total value of A shares is 50 rupees. If you deduct this 37.5 from 50 rupees, you will get 12.5 rupees, which is actually the value of A Limited standalone entity. You can also do this calculation on a market cap level. For example, A has an investment of 7.5 crore rupees in B Limited. 50 lakh shares of 15 rupees each, 7.5 crore rupees. And an investment of 30 crore rupees in C Limited. Combining both, A has an investment of 37.5 crore rupees in B and C Limited, and market cap of A Limited is 50 crore rupees. 50 rupees and 1 crore shares, 50 crore rupees. So now if we deduct 50 crore rupees minus 37.5 crore, you will get 12.5 crore rupees. And there are 1 crore shares, so 12.5 crore divided by 1 crore, again you will get 12.5 per share. This 12.5 crore per share or 12.5 crore in the market cap level is the value of A Limited. Now let's imagine that the EPS of standalone A Limited is suppose 5 rupees. So the standalone A Limited is trading at a PE of 2.5 rupees, right? 12.5 divided by 5, so a PE of 2.5 rupees. But the industry in which A Limited operates, standalone A Limited operate, has an average PE of 5 rupees. It means that A Limited is very undervalued, right? And we get an opportunity to make a money here. So by doing this exercise, we can find out the actual value of A Limited, and we can figure it out that if it's overvalued or undervalued. Now one very important thing to keep in mind while doing this calculation is that final stage, when we'll be doing valuation of A Limited, we'll have to take earning or sales. If we are using PE or PS, we have to use earnings or sales of standalone A Limited only, because B Limited and C Limited stakes are already going to be sold, right? So we have to use the figures of standalone A Limited. Or if we are using the price to books value, then the book value has to be adjusted, because that investment in B and C will not be there, right? So our book value will also be get reduced because of that. So we will have to use the adjusted book value.
So now let us discuss about the concept of merger securities. So typically when a company goes on to acquire another company, or say a company is trying to delist itself, this company has to compensate the existing shareholders in the form of cash. But in some cases there are warrants issued or even CVRs issued, right? So we'll understand about contingent value rights. There are like the rights issue that happen, preferred stocks, right? Now, typically, the existing shareholders are more focused on the cash outcome of it, right? So they'll always try to measure the difference between the current market cap or the current market price and what is being offered as cash, right? But these instruments, the extra instruments that were issued, for example, warrants or the rights issue or the CVRs, like I mentioned, these are completely ignored, especially by the institutions, right? Because they do not have it in their mandates to invest in these securities, right? And the size is often too small for them. So sometimes opportunities also arise in these kind of securities, right? So for example, in his book, Joel Greenblatt discusses about how in Super Right Foods, so Super Right Foods was also a company mentioned there, which got delisted, right? Now during the delisting, there was a $25 per share cash that was paid to the existing share, that was supposed to be paid to the existing shareholders. But on top of that, there was a dividend yielding instrument with a face value of $2 at 15% yield was issued as well. Then there was warrants issued as well on top of that. Now the thing is that the issuance of warrants, the bonds, people don't consider that, right? People hit the sell button instantly. But this is where the value arises, because whenever the sell off happens, they become cheaper and cheaper, and usually the alpha lies in these instruments. So those are the concept of merger securities. Thank you.
Now, another special situation that people often try to make money out of is risk arbitrage. Let's understand what risk arbitrage is through an example. Let's say there is company A and company B. Now, company A wants to acquire company B, and it says that it will acquire company B at a price of around 40, whereas today it trades at around 20. Even the ratio that is given by company A is that basically for every share that someone holds of company B will be given a share of company A once the merger is complete. Now, as soon as this news comes out, the company B stock, which was trading at around 18 or 20, now shoots up to around 38, where it should have actually shot up to 40, shoots up to 38 because there is a time differential for the merger to be completed. Now, arbitrageurs actually try to make money out of this differential that comes about. Let's say the company B is trading at 38, should trade at 40. What they do basically is go long on company B's stock at 38, and they short company A's stock. That is to hedge their risk, because what if the merger doesn't go through? Then they will actually be able to limit their losses because of that. Now, what happens in such a case is that this once the merger gets completed, company B shares are converted into company A shares, and the arbitrager can then cover his shorts using these new shares of company A that he has got, and the 2 rupee differential is what the arbitrager would then make. Now, in theory, this makes a lot of sense, but the risks are actually skewed towards the downside in such a scenario, because you're actually making money in a few percentage points, but actually the possibility of you losing money is actually higher. Now, what are the perils of risk arbitrage? Firstly, there is like, what if the deal failure happens? Of course, there's a time risk, right? I mean, mergers can take around 6 months, 7 months, 8 months. We don't really know. Some might happen in a month as well. But again, time is a factor. And in that time, what if there are some unthought of tragedies with the company? Like, let's say company B owned a plant which was in a location that was impacted by an earthquake. What would happen then? If the merger went off, then company B's valuation would again, like the stock would again fall to 18. And what if at that point of time, company A's stocks actually did not fall as much? So your short would give you money, but not as much as your long would lose. And that would then result in an eventual loss.
Let's discuss bankruptcy. Bankruptcy is a legal procedure initiated against individual or business who is not able to meet their current debt obligations or other outstanding obligations. In India, bankruptcy is governed by Insolvency and Bankruptcy Code of 2016, and basically this code is more friendly to creditors and debt and bondholders, etc. It is not so much shareholders friendly. If you look at the pyramid of the payments or hierarchy of the payments during liquidation, the shareholders are at the bottom of the pyramid, right? The bondholders, the creditors, the employees, they are all on the top of the pyramid, and shareholders are at the last of the pyramid. But the author says here that a company who is emerging from bankruptcy may provide an opportunity for as a good investment, right? So basically, what happens is when a company is emerging from bankruptcy, obviously they don't have much cash or money to pay to their bondholders and creditors, etc. So they issue them shares, right? And the original equity shareholders they actually get diluted. But those bondholders and creditors they don't want shares; they want money. So they are very anxious to sell those shares as and when they get it and that are listed, and they anxiously sell the shares, and these are generally not covered by exchanges or brokers, because as compared to IPO they get huge commissions while they are covering IPO markets, right? But here, as they are emerging from bankruptcy, they have a stigma, so investors are also not much interested, and investment bankers or brokers don't get commission much here, so they are also not interested. So these are very authors call them orphan stock, right? Because they are not covered much by analysts and others, so there is a possibility of getting a cheap stock here. So within this type of companies who are emerging from bankruptcy, if you can find any one company or who has a very good business, then that can be a good opportunity. The author says to read disclosure statement, which is a public document filed for bankruptcy, and it contains all the details regarding the future provisions and etc. So author says to read that document to gain very detailed information about the same. Author has shared some ideal scenarios for example, leverage buyout. So what happens in leverage buyout is management decides to take that company private or reduce the floating share for the public. So they take a debt to buy back the shares from the management from the public. But because of this, their business become over leveraged, right? Because they are borrowing funds. And if some short term problem arises, so their business gets impacted and they may become bankrupt. But overall, they have a good business, and this short term problem will be solved within 2 to 3 years, right? So you can invest in those kind of businesses. Next is when that bankruptcy is taking away one division which was loss making. For example, within a conglomerate there is a one division which is loss making, so it is consuming the cash of other cash rich divisions, right? And it may be becoming bankrupt, right? So if that division is getting liquidated, it will improve the prospects for the other good businesses, other good divisions, right? And another could be when there's a settlement of a product liability lawsuit, right? So for example, if you one of your product is not very much in the interest of the public, and there have been many petitions and huge claim for that compensation, that amount of compensation can be more than the net worth of the company. In that case, that they can go for bankruptcy, and because of that one product bankruptcy, that will be separated from your business, right? And other products will continue to perform. So it comes an opportunity to make the money. Author has further said to focus on a very small companies because they are generally neglected by large investors. He has called vulture investors who majorly focus on this kind of investments, and they are also ignored by the analyst and larger market. He used a term called orphan securities because they are not actually tracked by many. Author has shared a case study of Tata Medical, which operates 78 psychiatric stores. In 1988, Tata Medical went for a leverage buyout, increasing more than $1 billion debt in their balance sheet. And it was followed by industry pressure and pressure from the insurers to reduce their cost and reduce their average stay of the patients. In fact, average stay of the patients fell from 30 days to 20 days, and it severely impacted their revenue. And because of this, they were not able to serve their debt. So finally, in 1992, they went for bankruptcy and restructuring, where majority of the shares were given to the bondholders and etc., and their debt was reduced. The author tries to value that company according to their peers, and he found out that the actual share price, their fair value, should be around 15. But at that time, Charter Medical was trading at just $7 at 50% discounts. He thinks that discount could be because of recent stigma of bankruptcy or the pressure in the industry, or it could be because of still there is a sizable debt in their balance sheet. But he thinks that still these factors do not justify this 50% discount. And along with that, management strategy to control their cost, to grow their patients marketing, to sell conventional hospitals, and to grow their outpatient services were executed very well. And this resulted in share price increasing from $7 to $20. So this is a classic example of orphan security of an equity which was just out of bankruptcy, and it made a 3x return for their shareholders.
Let's discuss what is corporate restructuring and how does it work. Corporate restructuring just means a company making a big change in its setup, like selling a business, shutting a division, or separating parts of the company so that its core business becomes more focused and clear. There's a very good line by investor Bharat Shah that when good, bad, and ugly are together, valuation given that are of ugly. A lot of companies don't look very profitable from the outside, not because everything they do is bad, but because a good business and a bad business are sitting together. And when that happens, the bad business usually hides the strength of a good one. Think of a simple example. Suppose one part of the company earns about $2 per share, while another part loses $1 per share. And when you combine them, the company reports earning of $1 per share. So the market looks at it and say a very low quality average company. Now imagine the company removes the loss making part. Nothing new is created. The profitable business is the same as before. But now that $1 loss is gone. So earnings jumps from $1 per share to $3 per share. That's what people mean when they say restructuring unlocks value. The value was already there, it wasn't just visible earlier. This is exactly what happened in the Greenman brothers. Greenman had two businesses. One was a wholesale toy distribution business that was low margin and getting worse over the time. The other was a retail toy business called Noodle Ki Doodle, which was actually doing quite well. From the outside, Greenman did not look attractive at all. The stock was trading below $6. Even the book value was around $8. That tells you how unattractive it was to the market. But inside Greenman, the retail business was the interesting part. The problem was that it was being dragged down by the distribution business. At some point, the retail business needed capital to expand while the distribution business was consuming the capital and delivering poor returns. So this created pressure on the management to act, and this was the catalyst in our case. So they decided to restructure the company. They sold the wholesale distribution business and focused entirely on the retail business. Once that happened, the company's numbers become much cleaner. Investors no longer saw Greenman as a struggling distributor. They started seeing it as a focused, growing retail company with a growth potential. Because of the change in perception, the stock re-rated, and within a few months, the share price moved from $6 to around $14. Nothing extraordinary happened operationally in the short period. The main change was the structure of the company and how the market viewed it. So investing during the restructuring creates a profitable opportunity, but a few things should be kept in mind. Number one, look for margin for safety. In our case, the book value per share was more than the trading value per share. So this created a margin. Number two, make sure the company has a promising and the growth making business left after the restructuring is done. Number three, look for reason which could act like a catalyst for restructuring. And fourth, ensure that the restructured business is tangible enough to make profit in comparison to original business.
So now let us get into the current affairs part, and we'll start with the analysis of economic indicators. Now, the data that I'm going to present to you will have very divergent views, right? Some of the data will be good, some of the data will be bad. But internally, as an economy, there are green shoots that are visible, right? So first of all, let us look at some of the bad sides, right? So for example, PMI manufacturing and PMI export have moderated quite a bit, and they almost go hand in hand, mostly because of the tariffs that came into effect, the 50% tariffs that came into effect from August, right? But nothing, not all is gloom and doom. As we can see, due to the recent GST cuts, the tractor production, the passenger vehicle production, the three-wheeler production have seen a very decent uptick, and it doesn't seem like a one-off in the trend, right? And especially in terms of construction activity, if you see the crude steel production, the finished steel production, even the cement consumption and the production have almost are almost running at all-time high percentages, right? And the one of the main indicators that I think that shows the bounce back in the economic activity is the retail commercial vehicle sales, because this is directly linked to the industrial production activity, right? And as you can see, the retail commercial vehicle sales has been positive for continuously for the last 2 months. So these are some of the signs that probably the economic activity is reviving, right? Now let us look at the recent monetary policy changes that have happened, right? So cumulatively, as you know, from January, RBI has gone for a 125 basis points repo rate cut, right, and a 100 basis points CRR cut. Now, the results of this should be obviously visible in the credit growth as well, right, or in the money supply at least. So as we can see clearly, due to the CRR cuts, you can see how the reserve to deposit ratio has fallen, due to which the money multiplier has actually gone up. So money multiplier simply means when there is a certain amount of liquidity that is injected into the economy, it is invested into businesses, and how much are those businesses again reinvesting back into their businesses and generating even more capital out of it, right? So a healthy multiplier growth suggests that the rate cuts are working, right, that the transmission of the rate cuts are happening into the economy, right, the actual transmission. And it is also visible in the all-time high credit, not all-time high in the, sorry, I'm sorry, but in the last 10 to 15 months, we have seen the highest credit growth uptake, right, at 11.5%. And a lot of it is driven by also the personal loans. Like we know that the underlying personal loans have the gold loans, for example, right? So gold loans have been growing at a very, very healthy pace, mostly due to the increase in the prices of golds, due to which, like I mentioned in the previous video as well, even at a constant LTV, the loan growth, there has been a decent loan growth uptick, right? On top of that, there has been a very healthy uptick in the growth of credit to industry, credit to services, as we can notice. So these are some of the good things that are happening, right? As we can observe on the industry, that there has been a pickup of credit as well. But again, as I said, I wanted to give you the both the views, right? So as we can see, there has been a very large foreign FPI outflows, right? Now again, granted that the FPI, we have to also depend on more on the FDI outflows, right? Because they are more structural in nature. But even the FDI outflows has been negative or almost close to nil for this year, right? Next is the manufacturing and the business confidence slowdown. Like I said, the manufacturing PMI, the export PMI export have all been moderating, right, for quite a while because of the lack in exports, right? Then on top of that, as we can see, the housing sales have also fallen, mostly due to a drop in the affordable housing sales as well. Now, the credit deposit ratio being at 81% high is not necessarily a bad thing, because we need credit growth as well. But it should be followed up with the deposit growth as well, right? Because if there is no deposit growth, the profitability of banks actually shrink, right? So that happens because of the deposit repricing mechanisms, right? So when rates get cut, banks cannot immediately cut their deposit rates, right? So that compresses the profitability of banks, right? So that's one thing. Youth unemployment. So as for us, RBI only targets inflation, right? But for countries like US, they have the dual mandate, right? They target both inflation and the unemployment rates as well. So as we can see, the youth unemployment is still extremely high despite cooling inflation. The bargaining power of labor force is still low, right? And the final problem is that even if there has been a very, very healthy real GDP growth rate, the the lack of nominal GDP growth rate creates problems. Why? Because it ruins the fiscal planning for the government, right? Based on tax collections are directly dependent on the nominal GDP, not the real GDP, right? And because of that, you can see the recent news on where the taxes for cigarettes have gone up, right? If you can see that, so they are trying for other ways on how to increase the tax receipts, right? And finally, we can see that the electricity gen and natural gas gen and crude oil gen have been weaker in nature as well, right? So these are some of the negative parameters as well. But all in all, as the economic activity picks up, and the capacity utilization, which we can track through because picks up, we can see a decent few quarters in the coming, because now what we have is a slack in the economy, right? So as the fiscal consolidation, so we know that the government is aiming for fiscal consolidation, and we are now at 4.8% of GDP. As the rate of contraction stops, so for this year it was almost 130 basis points. As the rate of contraction stops, so it's like a headwind, right? So as the rate of contraction stops or slows down, we can get back to the nominal GDP, nominal, both the nominal and real GDP growth rate back. So that is it from my side. Thank you.
So let's move on to the tariff updates. Now, initial announcements suggested that the trade weighted average tariffs would be around 25 to 27%, but after economists actually studied and analyzed the revenue collected divided by the imports, they realized that the actually implemented tariffs were about 10%. Now, these tariffs have completely been borne by the American consumers and importers since foreign exporters have not lowered their prices. Now, while the trade delegation was in India recently, and they said that India's latest offer was currently the best that they have offered so far, and the offer is under the review in the US administration, Trump has once again threatened extra tariffs on India for importing Russian oil. This comes even as while in November, India's imported Russian oil was 35% of its total oil imports. In December, it had fallen to around 25% and is expected to fall further. But Trump says that continued oil imports could cause tariffs increase up to 500%. While India manages its trade relations with US and Russia, India is also beginning to diversify its exports. The marine products exports to China has actually risen to around 20.6%, and in Thailand it has risen by around 7.3%. Electronic goods share export share to UAE has risen from around 8.8% to 15.5%, and gems and jewelry exported to Hong Kong has now reached around 11% of total of India's exports in that. Now, as a relief to many furniture and pasta exporters, Trump has delayed his extra tariffs on furniture and pasta by around 1 year. For India, uh, USA is the largest export market in furniture, and the not increasing of tariffs comes as a relief to furniture exporters. So that was all for tariffs for now. Now let's move on to AI. Now, let's move on and build over what we spoke about AI last time. While we spoke about a lot of jobs that could be lost due to AI, there could be new jobs that would be made as well. And some of those jobs are the jobs of like machine learning practitioners or AI system specialists who actually mine a lot of complex data for AI to study on. There is also AI trainers, prompt engineers, chatbot developers, which are basically development roles in very specific domains. Like there are AI powered personalized learning managers, which actually would help a lot in the education field, or fraud detection using AI, which would help a lot in the financial fields. So, such kind of jobs are being created. Now, Anand Mahindra, who is an automobile industry baron, says that AI is an accelerator and not actually a threat. It can turn blue collar jobs into gold, which is they can enhance their fortunes by actually learning to work with intelligent systems and artificial intelligence. While this holds to be true, it is also true that India's 90% workforce is actually in the informal sector. And this workforce seriously lacks resources like time, savings, and institutional support to actually upskill themselves. Now, while India aims to become at least 10 to 15% of the projected 17 to 26 trillion dollar AI market, these are the gaps that India must fulfill, and the government is taking a lot of steps to do that. They are democratizing AI to build a bridge between the divide, which is basically now India's English literacy is around 18 to 30%, which is basically the out of the population, 18 to 30% people know English. So India is a very diverse country with diverse languages. So India is building a lot of language models and an AI course repository, which basically involves 6,000 local language data sets. Now, alongside that, India is also accessing ease and like subsidizing AI compute so that companies can get up to speed with the world with regards to AI. The Digital Shram Setu mission, which India has now started, is catering actually to bring subsidized or actually bring healthcare, upskilling, and financial services at a much cheaper cost to the larger public, which will also help in actually formalizing this whole economy. Now, while this was a bit on the risks that India needs to mitigate and opportunities that India needs to grab, on the business side of things, India's first ever AI unicorn, Fractal Analytics, has filed for an IPO. In the listed side of things, the Indian IT firms are trying to mitigate the bridge or the gap between their services and AI offerings. They are doing this through the inorganic route of acquisitions. In this year alone, Indian IT firms have announced acquisitions worth $4.3 billion, out of which $2.3 billion, $2.39 billion was Coforge's acquisition of Encora. The rupee very recently has fallen as low as 91.14 against the dollar. But it has not just fallen against the dollar, it has also fallen against the British pound, the euro, and the Japanese yen. Now, when you are looking at the currency, it's not just important to look at it against the dollar, but against all the trading partners that India has. And that is why it is important to look at the near and the rear. Now, the near is the nominal effective exchange rate, and the rear is the real effective exchange rate. Now, this it basically it's an index created with a weighted average method against all the trading partners, and through it we can track how the currency is moving. Now, the real in the last 1.5 year has fallen by almost 10%. To be precise, fallen by 9.8%. Now, why is this happening? First is basically the nominal fall that the rupee has had against other currencies, and also because the inflation in India currently is at very, very low levels. So it is not able to set off that inflation against other currencies because usually India has a high inflation. Now, it is important to put this fall into perspective because, as we know, that the rupee has fallen because of a increasing current account deficit, the tariffs, and an increasing import from of cheap goods from China. Now, why is this fall important and why it is not a disaster, but the fall makes sense? It is because it acts as a shock absorber for the economy. I mean, if the current account deficit is widening and the rupee is falling, that means in dollar denominated terms, we would have to pay a little lesser to fix this deficit. It is also offsetting against tariff pressures. How is that happening? Basically, if the rupee falls, when we export goods to, let's say, US or another place, we get more dollars because the rupee has weakened against the dollar. Now, it also boosts competitiveness. Basically, ever since just before the COVID, India exported around 54 billion worth of goods from China. But since the tariffs, China has been diversifying and China has been exporting to other countries, even dumping in some. And because of that, cheaper imports to India from China have ballooned to 114 billion. Now, even though India's currency has depreciated against the yuan, because of China's deflation, China has actually, in real terms, grown by 10% against the rupee. And that is why it becomes important to kind of keep the rupee depreciated against the yuan so that our manufacturers can be competitive against cheaper imports from China. It also acts as a complementary to domestic policy as an external easing when domestic inflation is low and manageable. Basically, there we can the RBI can cut rates and improve liquidity into the system. Now, if you look at the impact that the depreciation of the rupee has on inflation, it is not much. Every 5% of depreciation in the rupee causes only 0.15 to 0.35 percentage increase in the inflation, which is largely manageable because our external debt is actually very low and households are able to manage this very easily.
Let's understand what is an IPO and then get into the IPO frenzy. An IPO is simply the first time a private company sells its share to the public. Now there are two ways this can happen. Number one, fresh issue. The company issues new share and the money goes into the business for growth, capex or debt reduction. Number two, offer for sale. In this, the existing shareholders sell the shares and the money goes to them, not the company. Now most IPO today are a mix of both. This matters because it tells us who the IPO is really designed to benefit. Now here's the first important insight from the data. Over the last year, we had around 344 IPO and about 1.6 lakh crores raised. Activity peaked in the month of November and October. On the surface, this looks really bullish, right? But high IPO volume does not mean high investor return. It mainly tells you that conditions were attractive for seller. That becomes clear when you look at returns. The median IPO return is around 0%. That means the typical investor did not really make money. The average return is about 14%, but the number is misleading. It's pulled up by a small number of big winners. So IPO outcomes are extremely skewed. A few successes dominate the narrative, but most IPOs deliver average or poor result. Now looking at listing day performance, about 72% of the IPOs listed above issue price, which creates excitement. But later on, around 50% of the IPO are trading below their offer price, and 94 IPOs are underwater, having lost all the listing gain. This tells us something very important. Listing day gains are mostly a short-term pricing event, meaning the price is driven by temporary demand and hype at the time of listing and not by the long-term strength of the business itself. So the obvious question is, if returns are so mixed, why do IPOs keep coming? The answer is incentives. IPOs provide liquidity, which simply means early investors and promoters finally get a chance to convert their shareholding into cash at the market price. Now, the IPO creates a market for the share that were earlier not easily sellable. That does not make IPO bad, right? But it tells you that IPOs are primarily liquidity and pricing event that allow ownership to change hands and a price to be discovered, not guaranteed wealth creation events for the buyers. So IPOs are not broken, but expectations often are. As investors, IPO should be treated like any other stock, evaluated on business quality and valuation, not on hype, volume, or the listing day gain. Let me explain the PLI story in a straightforward way. The original idea behind PLI was not to instantly create deep manufacturing. The first goal was much simpler: get companies to produce at scale in India consistently year after year. If we look at electronics and smartphones, that phase has clearly played out. iPhone exports from India have crossed $50 billion cumulatively. At this level, production stopped being experimental, supply chain settle, vendors invest locally, and manufacturing becomes stable. That's why India now accounts for roughly 20% of the global iPhone production. This isn't just about one company shifting a plant. It reflects sustained capacity across multiple years. So once scale is achieved, the problem changes. Assembly by itself captures only 15% of the product's value. Most of the value sits in components like chips and modules. So the next phase of PLI is about moving into that layer. This is where the electronics component pipeline comes in. Around 42,000 crores of investment across 22 projects are aimed at raising domestic value addition to over 40%. That shift determines whether India remains an assembly hub or becomes part of the global value chain. The type of companies committing capital is also telling. When firms like Motherson Electronics plan investment of around 1900 crores, it suggests that higher complexity manufacturing is becoming commercially viable and not just policy driven. So execution is reflected in disbursements. In autos and EVs, progress is slower but visible. For example, Ola Electronic receiving 366 crores indicate that even new segments are beginning to move from approval to execution stage. Now, if we step back, the pattern is clear. PLI has already done what phase 1 was meant to do: establish scale in selected sector. Phase 2 is about depth, components, autos, batteries. Some sectors are moving faster, others are constrained by ecosystem gaps. So, the discussion today isn't about whether PLI works or not. It's about which sectors can scale into lasting competitiveness and which one will need more time.
We have already discussed what is China Plus One strategy, how it emerged, what scope it brings for India, and its present status. Today, let us start with what helped China to become a manufacturing superpower. First, their government initiatives and its policies. The government gave its unlimited lands at very cheaper cost to the manufacturers. They even funded their manufacturers to get good manufacturing equipment from Europe. Government also hired special agencies to supply workforce from rural areas, and they were made to work for 16 hours a day at a very low cost. And then government went on to create a huge manufacturing clusters, and there were sufficient infrastructure which helped the manufacturers. Also, they brought a law in between which mandated to transfer the manufacturing technology to the Chinese manufacturer counterparts. All this helped the global manufacturers like Apple to become lowest cost producers, and it was a mutual relationship. So these companies also helped China to become a manufacturing superpower. But as we have already discussed in the last video, the reasons to reduce their over dependence on China, geopolitical tensions, there was a need for manufacturers to have a plan B or shift some of their manufacturing out of China. Apple, which helped China a lot in becoming what it is today, also had to shift because it's of these mentioned reasons, and its competitors like Samsung were already diversifying its manufacturing plant. And India was a best alternative to China for Apple. India offers a lower geopolitical tensions, it has a huge workforce available at a cheap cost, and it has a huge consumer market for Apple. Along with that, Tata Group and etc. were purchasing stakes in the businesses which were indirectly supplying the materials to the Apple. So it was again a very huge advantage for the Apple. Although China still dominates today, but still experts estimates that it will take 5 to 10 years to build capability in India what China has today. And one of the recent important development in this area is Biosecure Act 2025. The US has passed Biosecure Act 2025, which restricts the transfer of genomic data, biotechnology, and healthcare supply from foreign adverse countries like China. Basically, healthcare and biotechnology are very basic necessity of a country, and no one wants to depend on foreign adverse countries for something like this, as this can be used for their disadvantage during war times. So this act was passed keeping this in mind so that they can prevent their basic data related to genes and hereditary, and also to secure its supply chain with at least friendly nations. The act bans the government entities and the entities which are funded by the government to engage on healthcare related trades with the companies of concern, and this designation of companies of concern will be given by the government from time to time. This reshapes the global biotech industry, and it creates a huge opportunity for contract development and manufacturing organization CDMO in India.